Hi, I'm Brian Yampolsky.
And I'm Joe Ashton.
And we're the co-owners of Orion Mortgage, and this is the Inside Track. Now, today's topic is why you don't always get the lowest advertised interest rate. There are three main reasons why you don't always get the rate that you might see on the internet or the newspaper. Joe, tell them the three reasons.
Top three reasons is one, market volatility. Every day, rates change, and sometimes they change intradaily, and that's based on economic news and world events that's coming out constantly. The second thing is that an advertised rate may come with a certain level of points. Points are fees that you pay, and the more points you pay, the lower your rate can be. So a lot of advertised rates go with really low rates, but sometimes they have high points, so you need to make sure you balance that out. The third thing is that there really is no one advertised rate that could possibly be available to every single borrower, because every single borrower has different unique circumstances in their finances. And the industry accounts for those. We have what we call loan level price adjustments that Fannie and Freddie have come out with, I think in 2008.
That's right. They were created about 2-3 years ago by Fannie and Freddie, and those loan level price adjustments, which are also called risk-based pricing, consist of 6 major factors. The most influential factor would be your credit score. If you have a high credit score, your rate will be better. If you have a low credit score, rate will be worse. The second most important factor would be the down payment or the equity that you have in the property. And then the remaining 4 factors that can influence your rate would be what type of property it is, whether it's a condo or a single family home, how you use the property, if it's your primary residence, a second home, or maybe a rental property. If it's a refinance, are you pulling cash out? That can affect it. And then lastly, if there's a second mortgage that needs to be subordinated on the transaction. Now, all of these price adjustments can be paid by the borrower, but they don't have to be. They can also be negotiated to be paid by the seller on a purchase transaction. The last way that you can handle it is by actually rolling those costs into the interest rate. Now, if you look on the screen, you'll see that on a $200,000 loan amount, the payment at 5% compared to the payment at 5 1/8% is really only $15 a month, or cover a lot of those price adjustments.
Good point. You know, I would say the most important thing about an advertised rate is that it's exactly that. It's an advertised rate. It's not really designed to do anything else other than to get the phone to ring. And once the phone rings, an advertiser, the likelihood of them converting a lead into a client goes up exponentially. More importantly, I think that you need to have a relationship with the lender that you're using, somebody that you know and can trust, and they're going to communicate with you proactively and constantly and give you the right kind of advice. If you don't have that relationship with somebody that you already know, you ought to ask your realtor or a friend or a family member if they know anybody that can help you with that, because I think having the relationship is probably the most important thing.
That's true. Now, if you know someone who could use some mortgage advice or might even be able to benefit from the information that we're giving to you on this video, please forward the video to your friends. There's a little forward button right below the screen. If you have questions about anything mortgage related at all, please call us at the phone number on the screen, or you could drop us an email. Email should be on the screen too. Again, my name is Brian.
I'm Joe.
Thanks for checking in, and have a great day.
All right.